Now, again, what is a ratio? Does anyone know that? Of course. Ratio is simply dividing one number by another number. If that makes sense, the answer makes sense. And different numbers may have different interpretations. So sometimes you can have percentage or times or whatever, but it depends on how you interpret it. But simply, a ratio is dividing one number by another. And now, which number do you divide by which other number? Depends on what you get at that. So that is a ratio. So that is very simple. We will be doing this. Only dividing one number from a balance sheet or from an income statement by another number from an income statement or a balance sheet. And that will give us a ratio, and then we will do the interpretation. Again, how do we do the analysis whether that ratio is good or bad? Again, what we need to do is to look into the company's trend, its own trend, whether it's going over the years, how is it going, and also comparing the company with the industry average. Or also, if you want to do a deeper analysis, you would also like to compare this company with the closest competitor. So industry average, there will be big, small companies in the industry, and you would like to compare this industry with its closest competitor. So you may want to do that. Now, there are different categories in the ratios, financial ratios. One of the categories, what we call the short-term solvency or liquidity ratio. So what is solvency? Anyone? Solvent, when we say somebody is solvent. Yeah, how easily can you pay your liabilities? If you're able to pay your liabilities, you don't have a trouble, we say this person is solvent. That doesn't mean the person does not have borrowings, but the person has liability, or the company has the ability to pay its liabilities. So that's what we call the solvency. So what we do in these ratios, in this category of ratios, we actually measure or determine the company's ability to pay its short-term liabilities. And what are the short-term liabilities? Those could be payables, those could be bills, those could be wages. Okay? Now, if the company is unable to pay wages to its workers, definitely it's going to be in trouble. Or if it can't pay its electricity bill, it will be out of power supply. So we need to know that the company is capable of paying its short-term liabilities. But again, that does not mean that in the long term the company may still be solvent. It may have trouble in the long term as well. And then we will have to look into the long-term solvency of the company as well. So the long-term solvency is also what we call as the financial leverage ratio. We will discuss that in detail. Now, here is another term, liquidity. What is liquidity? I think we discussed this term in one of the previous lectures.
I think it's the word beneficial cash.
Yeah. So if the company has assets that are cash or closer to cash, that means that the company has ability to pay its short-term liability. Now, a company may have, or a person may have 2, 3 buildings and cars and other things, but as we discussed last week, if I don't have cash, like $20 in my pocket, I may not be able to pay my restaurant bill in the evening, right? And that may get me into trouble. So I'm very good, like I've got lots of assets, but those are not liquid assets. I need cash to pay my, or maybe assets that are easily convertible to cash, so that I'm able to pay my short-term liabilities. So we will be looking into these long-term solvency ratios as well. So a company may be good, it has good cash in the short term, its short-term liabilities are okay, but in long term it may be in trouble. We will look into that. And then the third category is what we call the asset management ratios. Sometimes we also call these as turnover ratios, or you may also call them as activity ratios. Or you may call them operating ratios if you want to. Okay, now what does that mean? These ratios will tell us how efficiently the company manages its assets. Okay? So, for example, one of these ratios will tell us whether the company can quickly sell its inventory, or does it take a long time for this company to sell it. So I buy the inventory today, it takes me 60 days to sell that inventory. And my competitors can sell their inventory in 30 days. Does that mean I'm in trouble? Yes. I cannot sell my inventory quickly, but not a definite yes. Of course, we will need to look into that in more detail. But this is a sign of trouble, and we may want to investigate it further. Of course, it is better to sell the inventory quickly, but we will look into that. So this is the third category, and then we will look into profitability ratios. So of course, these ratios are more concerned with how much profit does the company make, and what is the return on assets, what is the return on equity, and those things. And these ratios are, of course, of more concern to the owners.
Sorry, sir. The long-term asset also consider under that asset management as maybe 1 year. Usually they don't sell their long-term asset after course of time. Does that also count on under asset? How they
Okay, got it. So the point is that when we talk about long-term solvency, what we mean by this is that the company has long-term borrowing. So it has borrowed from the bondholders, and it's a 10-year bond. So after 10 years, the company will have to repay to the bondholders the interest plus the face value of the bond as well. So these ratios will tell us whether the company may get into trouble when that time comes. Is it having a lot of borrowing? If it has a lot of borrowing, is compared to its other industry competitors, and its profitability and sales and total activity ratios are weaker, then we can understand that there may be something wrong. It is surviving on debt at the moment, and that debt is not due right now, but it will be due after some time, and the company is not performing well, so they get into trouble at that time. So it is not actually about the management of the long-term assets. It's only the long-term solvency, whether it will be able to pay its long-term liabilities or does it consider the debt its assets, but it doesn't. Yeah, when we calculate these ratios, we will take into account the debt and assets as well.
In the long-term solvency.
In the long-term solvency. So we will do that. And then we will calculate some market value ratios. You know that the price earning ratio, we do that a lot. What does that mean? How do we calculate it? We also talked about the dividend payout ratio. We would try to understand what market capitalization is, all those things. So that will be the next category. And so this is the main slide. And if you understand what is on this slide, you will be good for most of the chapter. Okay? So this is what we explained. Now we have these categories. Category number 1, we have the short-term solvency ratios, and there are 3 ratios, 1, 2, 3. And then we have the long-term solvency or financial leverage ratios, and we have got these 1, 2, 3. How do I get rid of this? Okay. 4, 5. Okay. And then we have the asset utilization or turnover ratios. We have got 3 ratios over there here, but things as well: capital intensity and total assets turnover over there. And then we have the profitability ratios, 3, 4 over here. You can have others as well. We will talk about them. And then we have the market value ratios. Okay. Now let's talk about them one by one. And when we discuss one of the ratios, I'll give you exercise to calculate it, and that will be that easy. Make sense? Okay. Now the first one in the short-term solvency, and again, to remind you that short-term solvency means the company's ability to pay its short-term liability. Okay, so one of them is the current ratio. what we do is, a ratio is dividing one number by the other. So what we do in this one, current assets, total current assets divided by total current liabilities. Now, both of these numbers are on the balance sheet, right? Simply take those two numbers, divide by each other. Sorry, not each other, current assets by the current liabilities, and you will get a number. Just as a hypothetical example, let's say that this number is 3. You divided the current assets by current liabilities, and the answer is 3. What does that mean in terms of interpretation?
The current assets are 3 times the current liabilities.
Exactly. The current assets are 3 times larger than current liabilities. Or in other words, current assets are 300% of the current liabilities. Now, on the one hand, it seems, okay, well, I have smaller liabilities and more assets, current assets. So that seems like a good sign. Well, I'll be able to pay my current liabilities if they come. But again, we need some further analysis. And also, this number needs to be compared with the industry average. So if this is a retail good or maybe a merchandising company or a general store, whatever, and the industry average is 10, current ratio is 10, just a hypothetical. We are far away from the industry average, and that may indicate a trouble. But if we are closer to the industry average, we may be fine. I mean, a little bit difference is okay. But again, you need to do a comparison, a trend analysis as well. How is the company going? So, for example, last year, the ratio was 2, and then the previous year before that, it was 1. So, again, you can see that we were in a big trouble in that first year, but we improved a little, and we are improving further. We're getting closer to the industry average. So even though we are still in trouble, but we are improving, and that's an indication that the processes are getting better. Okay? So the key thing, calculating the ratio is easy. Not a big deal. What does that mean? That in this case, 3 means that the current assets are 3 times more than the current liability. Is that good or bad? Again, you need to look into the industry average and the company's own trend.
Won't the current assets divided by the liabilities?
Okay, that's a good question. So Kevin is saying that should it not be 1? And that's it will be 1 only if current assets are equal to current liabilities.
But that just was. That's what because your liabilities plus your
No, not total assets. Only the total current assets.
Current.
Yeah, current assets. And only current liabilities. And they're not necessarily going to be equal. Ideally, the current assets should be more than current liabilities. If not, if they're even equal, we may be in trouble. Or if the current assets are smaller than the current liabilities, that may be a sign of big trouble. But again, we need to dig deeper into this aspect as well. Okay, now that you understand what a current ratio means, you also know that the current assets actually include cash, and of course cash is something that you can use for any payment of any liability. If you are bill to pay, you've got cash, it's that easy. Whatever you have to pay, if you've got cash. But not all the current assets are cash. Some of them are receivables, accounts receivable. So if your cash is very low, what you will have to do is that if I have a receivable from a customer, I'll call, hey, no. But of course, if you have terms with the customers, you cannot call them before time. But if they're overdue, you can call them, or maybe do different things and collect your receivables. In other words, convert your receivables into cash and then pay your liabilities. So if you have less cash and more receivables, maybe a sign of trouble. And again, this also normally includes inventory. Now, inventory is again 2 steps away from cash. So if you have a large amount of inventory, that will show that you have large current assets. And it may give a wrong indication if you do the current ratio. Current ratio equals to current assets divided by current liabilities. Now, if these current assets is a large number, but most of those current assets are in inventory, it may still indicate a problem, because what you will have to do is that you will have to sell your inventory to convert this into receivables, and then collect your receivables to convert that into cash, and then use the cash to pay your liability. So what some of the lenders will do is they say, I don't care about this inventory because that will take a long time for you to sell and then collect your cash. Show me your receivables and cash. So they will do, hey, I need a quick ratio. Show me your quick assets. These are what we call the quick assets. So that will be called as quick ratio equals to quick assets divided by the current liability. Current liability. So what are the quick assets? All the current assets minus inventory. Remove that. That will say, I don't care about that. Now this will only consider these two. And if this is still better, maybe more than one, is a good sign. But even in some cases, if the company is in trouble and it is going to another supplier, for example, going to sign a deal with another supplier, and that supplier says, I want to check whether you'll be able to pay my, receivable in time or not. And if the company is in trouble, they will say, forget about the inventory. You're not efficient to sell your inventory, so I don't care about that. And also, you're not good in collecting your receivables, so I don't care about that as well. Show me your cash. How much cash do you normally hold? And if you show them that your cash, which is what we call the cash ratio, you simply take the company's cash and divide this by the current liabilities. Suppose that this is still more than 1. Let's suppose 1.5. There's no question about the very good solvency. Even the cash that the company is holding is very large enough, 1.5 times more than the current level. So even if all the current, the employees and the bills and every current liability comes on the same day, okay, everybody is knocking on the head, still the company is able to pay everybody. They will still be in business because it has a large amount of cash. But is that a good sign to hold this much cash?
Not, I don't think so.
Okay.
Normally you have a lot less cash.
Yeah, you would not want to hold so much of cash that it's more than total liability.
Okay. So cash is an asset that does not earn
Any income.
any return. Okay. You may keep this in a savings account in a bank, but that doesn't earn significant. Rather than investing that in inventory or maybe investing that in other assets that will earn a lot of return. But holding a lot of cash means that you are just holding the owner's money in the company's account. What does that mean for the owner? The company did not give you the money to keep it in your account. They give you the money to invest it. So you have to find a ratio that makes sense. Now, what is good? Is the 1.5 good? Again, as you say, it depends. You need to compare this to the industry. Maybe the industry actually needs that. Okay.
Maybe it's a cash.
It's a cash business. It's a bank, maybe. And in that case, of course, the statements of companies vary depending on the nature of the business. So the balance sheet of a bank is going to be quite different from that of a retail business. But again, we will have a general understanding of
So I have this question. The quick ratio, you subtract the inventory from the current assets. But do you have anything else in the current assets except for cash, receivables, and inventory?
Yes, we do. So other current assets, maybe, for example, you have purchased bonds. You had some extra cash, and what you did is that you purchased bonds, and you don't want to hold those bonds for years. Just you bought it because you have extra cash, once you utilize that threshold. Or maybe you purchase another company's shares. So all these bonds and shares are what we call the short-term investments. So that may be another type of.
So if I'm considering quick ratio, all I need to subtract is inventory.
Inventory, yes.
So if I have bonds or if I have shares or anything, I need to consider that as my.
Yeah, those are quick. And the reason is that if you have bonds, you can quickly sell them.
Right. Yeah.
If you share, you can. In a fair market value. Of course, you can sell your inventory quickly as well.
You won't get the fair market.
But you won't get the fair market value. But in case of bonds and shares, you will of course get the fair market value. So they are quick assets. Make sense?
Yes.
Okay. So now what we're going to do is that we're going for a break. But before that, you've got these statements, these ones that we were considering over here.
So the ratio will be 7.1.
Yeah. So 7 times more than the interest.
Okay. Yeah.
So it makes sense. For the other one, which is here times interest ratio, it is talking about EBIT. EBIT over here is interest before interest, right?
Yeah.
Equal to before interest. So just the depreciation is out. So
Yeah, that's the one just the EBIT and interest. That's one just did.
yeah. Right. No, the thing that you did was EBITDA. Right?
EBIT.
No, you divided.
No, we did the,
No, no.
we did the 61,550.
Yeah, I just did the interest time interest earned ratio.
So
Yeah, he did 61,550.
you divided 61. Okay.
Yeah,
So okay, this is 7 times, and this one was 8 times, then, right?
yeah,
Because
correct,
they
yeah.
add 8 more. Okay, I'm
Yeah.
yeah. But future is 8 times, 7 times, and cash coverage ratio is like 8 times. Oh, that's good. 7 numbers. Yeah.
I think, yeah. So it's just like that. Get back at this time.
Guys, are you guys having break over there? Ankara?
Still have the mic.
No,
Oh, you took it off? Oh,
hello?
Hello.
Are you guys in break right now?
Yeah.
Oh, okay.
For how long it will take?
He said,
Until what?
I don't remember what time he said to come back.
Whenever he comes back?
Probably got like 7:55. 7:55.
7:55, okay.
We know you're looking waiting for some instructions and he got home.
Shot of whiskey.
Keep the camera off.
Hey, is it cooler down there? Is the temperature in the room a lot better?
Yeah, the room is a lot better, yes.
oh, the hot
That room.
90 degrees in this room.
And you should come here. Why don't you travel? There's no teacher here, man. Come on.
We teaching ourselves.
And we have the controls. We can. No, okay, let me not stop. Leave it is. Don't listen.
This is a long term to dealing with total assets, but like
Okay. So on that for the short-term solvency ratios,
Yes.
did you have go through the others as well?
It started.
Okay. So let's understand the logic, and honestly, the calculation is very easy because all those numbers are on the statements. Or now you're familiar from financial statements, so that's easy. Now, the long-term solvency ratios, what we check over here is the company's long-term solvency or insolvency prospects. So what this means is that if the company has large amounts of debt, they may be in trouble, and especially if the other ratios are weak, like it is not having good sales and profit margins and other cash flows and things like that, then it can be a trouble. So one of the ratios that we calculate is what we call the total debt ratio. So what we simply do is that take the total assets from the balance sheet, so this is the largest number on the balance sheet, and subtract the equity, total equity. So whatever is left is borrowed money, right? Total assets, when you remove the equity, the remaining financing is coming from the debt. So that may be a short-term debt or a long-term debt. Okay? And remember that this debt also includes the current liabilities, because this is the total equity just removed. And then divide that number by the total assets. So in other words, this is the total debt divided by total assets. Okay? Now what does that mean? Let's say that this number for you is 50%. What will that mean? That the company's debt is 50% of the total assets, or in other words, 50% of the financing is coming from the owner's equity and 50% from the debt. Now, is that good or bad? Again, we can't say anything at this point, but there are two things to consider. One is that what is the industry's average requirement for debt? So normally, for most companies, this should be between 30 to 40% generally, but again, it differs from industry to industry. And also, there is another concept, what we call the optimal capital structure. Optimal capital structure. The capital structure actually means the ratio of debt and equity. And optimal means is the ratio which optimizes the company. Now you know that if a company, we discussed this I think in the first class, if a company has zero debt, we saw with an example that the return on equity of that company is smaller. If we introduce debt in the company, the return on equity increases, right? And of course, that's a stimulus for the owners, because if you increase debt, return on equity increases, and that is what the owners want. So what the owners will do is that they would like to increase the debt further and further and further, and that increases the return on equity, or in other words, the overall health of the company, I would say. But there is a certain point that if you increase the debt beyond that, the company's health will be negatively affected in different ways. Okay? So this point at which the company is at a very optimal position, this is a combination, this is a debt to equity ratio, or the capital structure at which the company is performing optimally. Now, if the debt is lower than this, somewhere here, then still the company, in terms of solvency, it is very good because the debt is lower. But the return on equity will be smaller. And if you go beyond that point, the return on equity may temporarily increase because return on equity increases with increasing debt. But it has these solvency consequences, insolvency prospects for the company. And again, if the company's debt amount increases, that is a signal to the market that the company is okay. Okay? And then if you go for an additional borrowing from the market, either the market will not lend you, or if the market lends you, it will be at a very high rate. So the benefit will be diminishing. So this is what we call the optimal capital structure. Now the point that I'm trying to explain is that what is a good debt to assets ratio? In this case, I told you 50%. Is that good or bad? as I said, you need to compare this with the industry average. But again, if this company's optimal capital structure is 50%, then it is good for this company, even though it may be a little bit further from the industry average. Make sense? Now, how do we calculate this optimal capital structure? I explained this to you very superficially, but we have quite good complex calculations to do this. And if you are taking another finance course, maybe we'll look at those calculations and how to arrive at this graph and all those combinations. Any questions so far? Okay, so that is one measure. The next ratio is debt to equity ratio. Of course, I mean, like we understand, there will be the ultimate interpretation is going to be the same. But here what we do is that total debt divided by total equity. In that case, total debt divided by total assets, right? And here, the total debt divided by total equity. And this total debt may sometimes, you can just take it the total long-term debt. Okay? You can do that as well. Again, is that good or bad? Whatever the answer you get, maybe, of course, it is going to be something else. So, if debt in equity is equal, is in this case, if this is 50%, then this ratio is going to be 1. Again, this is 50, and that 50 is equal to 100% in this case. So this 50% and this 100% have the same interpretation. You can either calculate that one, interpret it, or do this one. That both mean, I mean, like, will have the same interpretation. Yeah. Yeah, so when we do this one, you may only take the long-term debt. The current debt may be eliminated, the current liability. But again, that will not make a very significant difference. Okay? And this one is something that we will use later on for some further analysis, what we call the equity multiplier. So this is total assets divided by total equity. So, if, for example, the answer for this is 2, we say the company's equity multiplier is 2. What that means is that the total assets are 2 times larger than the total equity. And again, this is the same as that one, different interpretations. Why do we call this the equity multiplier? Is that if you multiply equity by 2, you get total assets. Make sense? Or in other words, let's put it this way. Equity multiplier. Let's suppose that is 2. And we know that equity multiplier is equal to assets by equity. Right? You can rearrange this equation, which means that assets are equal to 2 multiplied by equity. So this 2 is what we call the equity multiplier. When we multiply this 2 with equity, you get the assets. Make sense? Now, when is this equity multiplier going to increase? When the total assets increase, but equity does not increase. Or maybe does not increase at that proportion. So, what is the scenario that assets will increase but equity will not increase? When we introduce more debt, or maybe buy back some of our shares. Okay? So in other words, if you keep this equity constant and increase the assets, that is possible only if you increase the debt. In other words, this bigger number for the equity multiplier means that the company has more debt. And having more debt ultimately means more return on equity. Okay? But again, that brings the other consequences of insolvency as well. And if it increases above the optimal capital structure, the consequences may be very bad for the company. Okay. Please do stop me if you have any question, okay? And just do participate. If you have to add something, please stand up and do it. Woodbridge?
Yes.
Yes, sir. Okay.
Okay, is it everything clear?
Yes, so far so good.
Okay. Now the next one is times interest earned ratio. Okay, so what we do is that we take the EBIT from the income statement, earnings before interest and taxes, and then divide that by the interest expense for the year. So let's take an example. You will do that practically using the statements that we have. But let's look at this. What we do is that we have on the income statement we have the revenue, okay, whatever the revenue may be 100, and then you take all the other expenses. I will just take it as 60. This includes cost of goods sold, administrative, depreciation, and not depreciation. It may be excluding depreciation, but anyway, let's look at that. Suppose that there is no depreciation. So what we have is 40. And then what we do is we remove the interest expense, and if that is, let's suppose, 10. Okay. Now what is this? This number is what we call EBIT, because this is earning before we have removed interest and we have removed tax, right? So this is the EBIT, and this is the interest expense. And if you want to calculate this ratio, what we call times interest earned ratio. Okay, that will be the EBIT divided by the interest expense, which is 40 divided by 10. In this case, that is 4. Now, what does this 4 mean? This 4 means that the company has got interest expense, and that interest expense has to be paid in any case, right? Now, whether the company is making any profits or not, interest expense has to be paid. And what we want to know is that the company has earned enough money, at least in this case, 4 times larger than the interest expense. Okay, it has earned 4 times more than the interest expense. So even if the interest expense is removed, it still has got 3 times of the interest expense left, and out of that 3 times, which in this case will be now 30, you will remove tax, whatever that tax may be, suppose 10, consider 33%. The remaining is going to be 20, goes to net income. Now, this is important because if a company is not earning enough money to pay for the interest expense, don't you think that's a big problem?
Well, because technology not part of the tax secret.
Yeah.
In this case, the tax
After interest. Yeah, because the interest expense is a tax deductible. It's an expense for the business. It's a tax deductible expense. So well, the benefit is that the IRS allows you to tell you, you remove all your expenses and show me your clear profit. Okay?
This is after this
Before you pay the tax.
like $40, but I don't need to pay tax.
Yeah, you don't need to pay tax at the $40. Your EBIT is 40. You then remove the interest expense, which is 10. The remaining is 30. So you will pay tax on the $30 or $30 million.
So if my interest is $40, like
Your interest is $40.
yeah.
Yeah. In case, let's suppose take this example. Your interest is not 10, but it's 40. Okay. So you have one thing that is clear is that your times interest earned ratio is 1. So you earn just hardly enough to pay for the interest expense, which indicates a trouble, because you're not operating only to earn for the for those bankers or debt holders. But the other thing is that in this case, when you pay this out 40, your taxable income is 0, so you don't pay any tax.
The only income, not for sales tax.
Yeah, sales tax is different. That goes right away when you do the sales transaction. So that will have to be paid. That's a different story. But there is no income tax. Sense? And of course, the sales tax is right away transferred to the customer. So when you buy something, they say, that's the sale price and plus this is the interest. So they collect the interest from you on behalf of the owner. So it's you that pays, as the customer that pays the sales tax, not the company.
So the sales tax never get your income.
No, that's a difference.
So the sales tax is not reflected on your whole.
But no, sales tax is not reflected on the income statement. Well, we put revenue on the income statement. This is the clear revenue. The revenue. So,
It's gotta come on.
well, for detailed purposes, you may put your credit card fees or some other things in the sales taxes. So you will have the gross revenue. Gross means the dirty revenue, which is just what you receive from the customer. Then you remove the sales tax, and then you remove the credit card fees, and then you get the clean revenue, and then you remove your expenses. But anyway, what appears to be revenue over here is your.
That's including the sales tax, right? Also, it doesn't have a separate entry for the revenue.
No, this revenue does not include the sales.
That's included.
It doesn't include the
So
sales.
this is free that.
This is so the accounting will work like this. Let me give you an example. You made a sales of 100, okay, and $4 or $6 is the sales tax. So how much cash did you receive? 104 you received from the customer. Make sense? Out of the 104, you debited the cash account because cash got into your pocket. Revenue is credited by 100 because only 100 is your revenue. Okay? And sales tax payable will be an accrual. Now it becomes a liability, and that is 4. So 4 plus 100 credit entry and 104 debit. So this revenue is already cleaned up. So this only works for business.
Yeah.
Do you understand his question? He's asking if we are filing personal income tax. Do we have to remove our credit card interest or any other borrowing interest expense? You only are allowed to deduct your interest expense paid on your mortgage. Oh, not that. So if you pay the credit card or whatever else, that's considered as your personal.
I get a question. So an item is $100. If I'm the customer and I buy that item for $100, it doesn't. No, it's $4 subtract total price.
Okay, so the tag on the product says sales price or price that says equal to $100.
Right.
Make sense? When you take it to the counter, they say, hey, okay, $100 plus $4 tax or $6 tax. In Virginia, the sales tax is 6%, right? Or depends on the products, varies, but then they will add the sales tax. So they will collect not 100 from you, but 104.
But that tax goes straight to the state. You don't see it, so you don't actually get the cash. 104, right?
For the company or for the individual, for the customer. Yeah, the company just get the cash. It does not right away. It does not go right away to the IRS. It goes to the company's account, and then the company pays it on intervals, maybe weekly basis, monthly, quarterly, whatever. But they pay it. But that's something like for the big companies they keep it very clean. So it automatically goes to the tax payable account, and whatever is accumulated, they pay it on quarterly basis or annual, whatever they want. Okay. So this one is now clear. the times interest cover. And the cash coverage ratio as well. What we do is that in this case we also not remove not only the interest expense but also depreciation, because depreciation is not a cash expense, right? So let's say we go back to same slide, this one. So, for example, in this case, you have earned EBIT is 40, and remove that. This expense 60 also includes depreciation. Okay, and then your interest expense is 40, so your times interest earned is 1. Like you just earned enough to pay for interest, but your cash may be a little bit more because in this case you've also included the depreciation. And let's suppose that the depreciation is 10. So even though your EBIT is 40, if you include that 10 back, this is going to be 50. Make sense? But anyway, that's not very important. You can simply skip that. So, would you like to do this for the exercise, 5 minutes? You may not be able to find some of the ratios depending on what we have on the statements, but give it a try. Do whatever you can. If you can find these numbers on the income statement and balance sheet, then you can find these ratios. If not,
That makes sense.
Which was
I don't know if the cash coverage balance is this balance sheet
this balance sheet?
or this balance sheet.
Okay, this balance sheet, right? EBITDA is already there.
Yeah.
The interest is over there.
Yeah.
EBITDA is how much? 68.
Yeah, 68
And
to 50.
Yeah, that's what this is.
interest, what we interest,
Yeah,
like
that's what
8
we're
times.
doing, right?
Yeah, 7.1.
Yeah.
No, this is EBIT.
Yes, I did.
This is EBIT. This is EBITDA.
No, we did that one, right? We did not.
No, the
No,
other
we did
one
that
that I was telling.
Yeah,
about
right.
the-
Yeah.
So tell them we did it, so you get credit.
Well,
I'm actually, I don't know if it was a credit.
What is this? It is about 8 times.
calculate all the long-term solvency ratios.
What's that?
We didn't hear what you said, sir.
Calculate all these ratios in this category.
Oh,
Over here, long-term solvency ratios.
Which number are we going? What number are we going to calculate?
You've got an Excel file. And you will put them down.
Oh.
So the first one is total assets.
Total debt ratio
Yeah.
equals. What is total assets?
Total assets minus total equity.
This is total assets. Total asset is these are assets right here from this sheet, right?
Yep. Total access is 249.
249.
Okay, 772. Yep.
Out.
Total.
Minus the equity.
Total asset is before which year? This year or this year? Let's do current year. 360. Yeah, let's make current year. Yeah. Minus total equity. Total equity here is. Here's that. These are the liability. We have to go and find it for here. Equity. Here. This is equity. No, this is earning. No, I don't put it.
Will we just do the 360, 770 minus the 73? Because the equity It's liability.
If it is liability.
Well, no, if it's total liability and equity. It's
A
this.
total company.
So if we just subtract the total liability, doesn't that give us the equity?
No, but there's the no term as, but no, here is what we are looking.
Right.
So
Oh,
this
I
was
haven't seen, I haven't seen
It's
that.
160, it's 162, right?
Yeah, 162.
Yeah.
So these numbers minus 162, right?
Yeah,
Okay.
divided by
Go back to,
162.
total assets.
go back to total assets.
It's not here, okay.
That's right.
Minus this over what?
Total assets?
360.
Yeah.
Okay, 49%. Right now. What is the second? Debt equity ratio.
Total debt ratio. So, which,
Total debt over total equity. Where is total debt?
It's like 80,000.
Long-term debt.
We don't have access to the formula.
Which term liability? Total liability. Here it is. Total liabilities. 154. Do you agree with that?
Okay, so the liabilities
Yeah, then
and the long-term
end
debt
of,
together?
yeah, end of
Okay.
the sum of the two. That's it. So it is, it equals 154,000 over total equity. Equity. Here's the
Where's the,
162. Oh, that's the equation.
Done? Everybody? Good? Okay. All right, Woodbridge?
thank you.
Yes, sir. Okay, let's move on to the next one. And this one is actually very interesting. And
What you think that's also.
okay, so the third category is asset utilization ratios. And what this is going to tell us is that how efficient the company is in terms of using its assets, utilizing its assets. What do we mean by utilizing assets or using it? If we have inventory and we can quickly sell it, we can say that we are efficient in turning our inventory over into receivables. If you cannot do that quickly, we are inefficient. But depends on the industry. Some industries need a longer time to turn inventory into receivables. Others will do it very quickly. And there will be some that do it only on cash, so there will be no receivables.
Yeah,
It depends on the customer, depends on the industry and the type of business. Now let's look into each one of them one by one. The first one is what we call inventory turnover ratio. And the name indicates, what do we mean by turnover? Turning something over, right? In this case, turning inventory over into receivables. Because when we sell the inventory, we turn it into receivables. And then we collect the receivables to turn it into cash. So inventory turnover actually means selling the inventory. Okay? So what we do, simply you will take this number, cost of goods sold, from the income statement. You probably don't have this number on this existing income statement, but let's just understand the logic. So cost of goods sold, and you will divide that by the inventory of the inventory balance, or if you want to be a little bit more meticulous, you will take the average inventory. So last year's inventory and current year's inventory, and divided by, and those two are divided by 2. So that will be the average inventory. So cost of goods sold divided by inventory, that will give you a number. Okay? Suppose that this number is two. Cost of goods sold divided by the inventory is 2. What does that mean?
turnover 2%. 2% of your turnover.
Why is the money not being cost of goods?
Simply, the cost of goods sold is twice the inventory balance. Let's try to understand this, because this is a little bit, it's interesting as well. Maybe a little bit complicated, but okay. So, what you do is that you buy inventory, right, for the business. So this is the inventory account. When you buy inventory, for example, you bought 100, you sold 50 out of this, you bought another 100, okay? Or let's make it simple. You bought 100, you sold 100. Then you bought another 100, okay? And you sold this 100, okay? But at any time, you cannot be out of inventory, right? Then you bought another 100. What is the inventory balance at the end? 100. Because you bought 300 and sold 200 out of that, the balance is 100. Now, on the other hand, when you sell the inventory, where does this go? It goes to the cost of goods sold. So you have this cost of goods sold statement. So when this inventory account is credited by $100, the cost of goods sold, which is an expense, that is debited by $100. So that goes to debit account over there. And then when this one is sold, this goes to the cost of goods sold again. So what is the balance, total balance on the cost of goods sold? That is 200. So now you know that this is the cost of goods sold and that is the inventory. Simply divide this, what will be the answer? Inventory turnover ratio in this case will be 200 cost of goods sold divided by 100 inventory. The answer is 2. In other words, what this means is that this company, this 2 means that the company was able to sell its inventory 2 times. Okay?
They were able to sell the inventory to what? 2% of the inventory or just 2?
Two times. Like the cost of goods sold is 2 times the inventory balance. In other words, the inventory was sold 2 times. 1 time and 2 times during this particular financial period. And if this is 1 year, that means it took 6 months for the company to sell its inventory. Make sense? 2 times during a year, what does that mean? If we buy it now, it takes 6 months for us to sell it. Are we efficient? Well, it depends on the business, of course. But 6 months may still be a very large period. If you are, for example, an automobile manufacturer or dealer, the inventory turnover may be a little bit longer. But if you're a retail store or a grocery store, you may want to sell your inventory within a few days. And if you are a vegetable, fresh produce company, you may want to have the inventory turnover just 1 day. If you cannot do it in 1 day or maybe in 2 days, you will be out of business. So it depends on the industry. Or what industry are you in? But in this case, that means 2. And in other words, 6 months in this case. Yes, please.
Yeah, you said the best thing to get an access to those and also the average inventory.
Yeah, the average inventory.
So the bigger differ, like when I use the lower inventory one, I get out and that gets the same.
No, you will not get the same thing.
It doesn't matter.
I mean, like using the average inventory number is for someone who is a little bit more meticulous. So that person may think, the inventory balance at this time is 100, but it could be for some reason. I mean, like this larger inventory amount. They just got, for example, a deal, and they bought in bulk right before making the financial statements, and that's why the inventory figure may be a little bit exaggerated, or at this time. So you will need to look into the previous year inventory and find the average. So that would be a more careful.
So if I'm solving a problem like that and I use my average inventory, I'll definitely get a different answer from like R that is like, but you still like give the person the max, right?
of course, I will see how you did it. And if you do it right, you'll get the credit. And if you do the average, of course, you deserve more. Because you took a little bit extra trouble to do it. Okay, so does that make sense? Okay, now what we do is that we can convert this inventory turnover ratio into days. So what we call this inventory turnover in days. So I will call it IT, inventory turnover in days. Simply what you need to do is take the number of days in the year, so days in year divided by the inventory turnover ratio. In this case, 365 number of days in a year, and divided by 2. So that will, what will be the answer? Half a year, I mean 6 months. You can put how many days, whatever. So but this will be 6 months, right? So it takes 6 months for the company to sell.
What is I here? What's I here?
Is this good or bad? Again, compared with the industry average. And also with the previous trend of the company. Does that make sense?
For days in the
Yeah.
So here, days sales in inventory, or we call it inventory turnover in days, as I have said. So 365 days divided by the inventory turnover, which is 2 in this case. Okay, then in the same manner, we do the receivables turnover ratio. So what will that mean? How good we are in collecting those receivables. When we sell our products and credit to our customers, can we collect our money quickly? If we can collect quickly, that means we are efficient. If we can't, we are in trouble. Or maybe our customers are not a very good credit score. They don't pay on time, or something like that. So how do you calculate that? You take the sales figure or the revenue figure from the income statement and divide this by the accounts receivable. And this accounts receivable is on the balance sheet. So one number is coming from the income statement and the other from the balance sheet. So the logic is pretty much the same. Let's do it. So suppose that we make a sales transaction. So this is our sales account. We made a sale of $100, and you know that sales, when we increase the sale, is entered on the credit side of the T account. So $100 sales. On the other hand, we converted this into receivables. So we have this accounts receivables account. So accounts receivable, $100 is now an asset. We will collect this money from our account. Okay. So then we made another sales transaction of $100. Okay. That goes again to accounts receivables. But in the meantime, we collected this 100 from one of the customers. Make sense? Again, we made another sales transaction. Okay, this goes on. So that sales, when we do it, it is added to the accounts receivables, but we collected this one from the customer. Make sense? What is the balance on the accounts receivable now? That is 100. 300 total accounts receivables generated and then 200 collected. But the total sales are 300 in this case. Okay. So what is the ratio? Receivables turnover ratio is equal to sales, which is 300, divided by accounts receivables, which is 100, that is equal to 3. So that means that we can collect our receivables 3 times a year. Or in other words, when we make a credit sales transaction, it takes 4 months for us to collect them. Make sense?
I think you can consider that $300 will just 1 year, right? That's the entire year.
Yeah, this is the entire year, and that is the entire year as well. But at the end, we have $100 balance in the inventory. Sorry, the receivables. The others have been collected. Okay? So, the larger this number, the better you are. Makes sense, right? And you can convert this into days as well. So you can have the receivables turnover in days. Again, 365 days divided by the receivable turnover ratio, which is 3 in this case. So if you do that, that will be 4 months, right? Okay. Now, pay attention to this because we're going to consider another ratio, and then we will combine all of them to make a better understanding of the scenario. Okay. Receivables turnover in days. Okay, we don't have the other one, which is what we call, that ratio is not included here. That is what we call payables turnover ratio. What is this? Payable turnover ratio. Okay. So when we purchase supplies from our suppliers, from our vendors, that goes to an account which we call the purchases. Okay? And the purchase is, of course, an asset account. Okay. So suppose that we made a purchase of 100 on credit. We didn't pay cash on that. So we generated another account which is called the accounts payable. This is a liability. We didn't pay this guy, this supplier on cash, so we will have to pay this liability. So we had 100 purchase and 100 payables. We made another purchase, so the purchases goes to 200 in this year. And that 100 is added over here. So again, this supplier is not waiting for us for a long time, maybe a month or two. So we will have to pay this one, 100 for example, so the payables goes down. Okay? Again, another purchase of 100, okay, and another 100 added over here, and suppose this 100 also paid out. So what is the balance in the accounts payable? $100 credit. And what is the balance over here? $300. Again, purchases divided by, the ratio is purchases.
Is that cost of goods sold?
Yeah, sorry?
Is that cents cost of goods sold for purchases?
No, it will be different. I'll explain that. Divided by accounts payables. In this case, 300 purchases divided by 100, that is equal to 3, or in other words, 3 times a year. And if you convert this into payables turnover in days, that would be 365 divided by 3, which is going to be equal to 4 months. Okay? All right. So this is what we call the payables turnover ratio. So should we have this ratio larger, bigger, or smaller? Smaller is better. Why?
So that you paying, like we're collecting money more, like if the receivables is larger, then we're collecting more, and if this is lower, we're paying less.
In other words, we are doing the business on our suppliers' money. Okay? But if the suppliers are not willing to sell us on credit, we will have to do the whole business on our own money. And that is what we call the net working capital that we do. So we'll talk about that concept. Okay. Now let's combine these ratios, it makes sense. Suppose that your business has inventory turnover in days plus receivables turnover in days. Okay? Just take a hypothetical example. When you buy your inventory, it takes 60 days for you to sell the inventory. That was 2 months, right? Plus, it takes another 90 days to collect your receivables. And just imagine a hypothetical scenario that your suppliers don't sell you on credit, so you have to buy from them on cash. Make sense? What that means is that when you buy this inventory at this time, you pay cash. So your cash is stuck right here. So you sell it in 60 days and another 90 days to collect it. That sum is going to be equal to 150 days, or equals to 5 months, right? What that means is that when you inject your cash into the working capital, it takes 5 months for you to get that cash back and re-inject. So you would like to make this period shorter and shorter, so that you inject the cash, get it back quickly, and re-inject it, and then do the process or the cycle quickly. And this cycle is what we call the operating cycle. What do we call this? Operating cycle. Makes sense, right? So you do that process now. Now, imagine another scenario that your suppliers are now selling you on credit. Okay? So, we have the inventory turnover in days plus the receivables turnover in days. This was 60 in our example, plus that was 90 in our example. Now, we have a payable turnover in days as well. And suppose that when we buy the inventory from our suppliers, they give us 2 months or let's say 1 month time. So 30 days, we will have to pay them in 30 days. Now you know that this cycle for us is 5 months, right? This is operating cycle. But the suppliers are giving us a 1 month credit as well. So if there is no cash, as we have in this, no credit in this case, our cash is going to be stuck for 5 months in the operating cycle. But in this case, what happens is that when we buy the inventory, we buy it on credit, so we don't have to pay right now. We will pay after 1 month. So we need to subtract this 1 month. Okay? And this is going to be how much? 4 months, or how many days? 120 days, or 4 months. In other words, our cycle shrink down. And this cycle is what we call the cash cycle. And this is the actual measure of how long does it take for our cash to be stuck in operating.
What was that? Purchase? What was that last thing?
Payables turnover in days. In other words, how long do we take to pay our suppliers? Inventory turnover? Okay. Inventory turnover, you buy inventory, so it takes 60 days for you to sell it. And then when you sell it on credit, it takes 90 days for you to collect your money.
Right.
Got it?
So what's the difference between that?
Okay. This is to your suppliers. when I buy, okay, when I buy this inventory, I don't pay my supplier right now. I will pay him after 1 month. Okay, so there's no cash outlay right now. But it takes for me 2 months to sell it, and then another 3 months to collect it. So after 1 month passes, when I bought this inventory, in 1 month passes, I'll have to pay my supplier because I have 1 month credit with credit term. But I don't have the money, so I'll have to manage it from another source of finances. Maybe borrow from a bank or whatever source you want to have. But you'll have to manage the money, pay your supplier because they're not going to pay. And if you keep them waiting, maybe, like you can delay payment tactics, but that will hurt your reputation in the business, and they will not do business with you the next time.
So, that whole formula, what is that actually telling you? Because you still have to pay 30 days. So, what?
Okay, let's go back over here. Consider this scenario. Your suppliers do not send you on credit. When you buy, you have to pay cash right away.
Right.
So, when you buy it, you pay cash. So, there is a cash outlay right here. Okay? So, your cash is stuck, and it took 60 days to sell your inventory. You didn't get the cash because you sold on credit. Then it took another 90 days to collect that. So 2 months plus 3 months. It took 5 months for you to get your cash back. You injected your cash here and you got it back over there. How long did it take? 5 months. Let's do it this way. A timeline will make it simple. So you started here. Okay? This is 60 days. And this period is what we call inventory turnover in days. You bought it and your cash is stuck over here. Okay? So it's 2 months, and then it takes another 3 months to collect it. So that will be receivable turnover days. So this is another 90 days. How much is that total? That is 150 days. Make sense? Okay. Now what happens is that you have a credit agreement with your suppliers. You establish your credit, you're a good client, and they say, okay, you know what? If you buy inventory from us, don't pay us until 30 days. So you bought the inventory here, so the inventory is with you right now, but you're not paying cash until 1 month. This is payable turnover in days. So this is 30 days. So when this 1 month passes, you will have to manage the cash from wherever you have. You may have your own cash balance, okay, in your bank. You will have to pay this client here, over here, right? Now, your cash, you paid it here. Your cash is now stuck for this period. Make sense? In the previous case, your cash was stuck from here to there. Now, your cash is stuck from here to there. This is what we call a cash cycle. Make sense now? Okay.
One thing called operating cycle. It's a cash operating cycle, or the term is that.
Okay, good. A good question. Is this 150 cash operating cycle or just the cash cycle or the operating cycle? In this case, because there was no credit purchases involved, this is operating cycle as well as the cash cycle. It's both the same. But in this case, the operating cycle is still the same, 60 days, but the cash cycle has been reduced by 1 month. Make sense? Okay. Now, is it possible to have a zero cash cycle?
Yes. pay the supply until
And,
we sold it.
is it even possible to have a negative cash cycle? Depends on how smart and how accurate and, depending on the business idea and smartness, you can have even a negative cash cycle.
Yes. You sell it and then you sell and then you get the money and you say that you will provide it 2 days later.
Okay, good. So let's say, take this example. You bought inventory from your supplier and you agreed with that supplier that you will pay him in 5 months. Make sense? Depends on the agreement. Maybe that is a sort of supplier that doesn't know how to sell the inventory, and you got it, and you know where to sell it. You're a smart businessman. So you bought it on 5 months credit, and now because you're very smart, okay, you sold it in 1 month, okay, and then you collected your money in the next month. So this is inventory turnover, and this is receivables turnover, okay? But you still have 3 months to pay your supplier. So you started from zero cash, okay? And you got the cash back in 2 months. Now you got that cash, maybe that is $5 million. You got it for 3 months. And if you are a smart man, you can go to another supplier and buy from that supplier on cash to get a higher discount. Because you bought it on credit for 5 months, of course the price is going to be higher. You can go to another supplier and buy using the same cash, buy very cheap, and still you are able to complete your cycle in another 2 months. So you've got another month and you complete 2 cycles. But I mean that will be an extraordinary situation. But depends on how smart you are. Any question here?
What is the difference? Equal total assets.
Okay. What we call this should more properly be total long-term debt.
Okay.
Total?
So there is no long-term equal offset that. Let's say total debt or total asset.
Yeah. So it should be a total long-term debt. Long-term debt. Yeah. It should. The term should be written as total long-term debt, but that doesn't make any big difference. I mean, if a similar question comes in your exam and you do it that way, it will still make sense. And for anyone for whom you do the analysis, you can do it either way. You can have another ratio as well. So you can have the total debt, which includes the short-term debt and long-term debt, make a ratio, and then make another ratio of total long-term debt only divided by. You can make another ratio only total short-term debt divided by total equity, and those will mean different things and different angles of understanding.
So total debt and total liability is the same.
Total liability and total debt is the same thing. But when you talk about total long-term debt, that is only the long-term debt on the balance sheet. Make sense? Okay, so we did it over here. Okay. Now let's go to the total assets turnover. This is pretty simple. Total sales, this number is coming from the income statement divided by total assets. That is coming from the balance sheet. So if this ratio is 2, for example, that means your sales are 2 times larger than your total assets, the total size of your company. In other words, if you were to sell your company, and buy another company and sell it, you could do that 2 times a year. But of course, you're not doing that. It shows like how larger are your sales is compared to this. So the bigger this ratio, of course, good, but there will be some, further analysis as well. A company may have a very larger total assets turnover ratio, but it may still be in trouble. Okay? and then capital intensity. So that is total assets divided by total sales. So this is the reverse of that ratio. Total assets divided by total sales. So this will be, let's suppose that this is 0.5. If the other ratio is 2, this is equal to 0.5. What does that mean then? Capital intensity. In other words, it takes $0.5 for you in total assets to make a $1 sale. This can be 0.5. For example, assets are 1 and sales are 2. Now, it's not actually a profit. What it means is that your total assets are half of your total sales. In other words, for every $2 of sale, you need $1 in total assets. And what you use this for is that, for example, you are projecting your sales to be double next year. So if you want your sales to go to 4, this will go to 2. So you have to increase your assets. And of course, those assets have to increase proportionally. So you have to increase your cash, your receivables, your long-term assets, your building, your car. Otherwise, if you double your sales without doubling your assets, you will not be sustained. You will not increase. Make sense? Okay. So I think from the current statements, you may not be able to find probably most of these ratios, but you can give it a try, maybe 2 minutes. You can do all? Okay. Give it a try then. You try to this one, and these are very easy. Profitability ratios, do this as well. Not a big deal. Profit margin, net sales divided by total, net income divided by total sales. Okay, so you don't have this one? All right. Okay, do the rest of them. Do whatever you can. And also do this one. You know, net income, the sales, return on assets, net income divided by total assets, return on equity, net income divided by equity. And then we will discuss this one later. So take like 2 minutes to do this. 3 minutes. 5. Can you run that again?
What would be the difference between operating costs?
You will need to use this.
Your magic
Yeah. So which one you? Profit margin?
Yes.
Okay. Margin. Okay. What is the net income?
31,800
31,800
divided by
which is 455 something. Okay, 6.98, almost 7%.
so then
So they're selling for 7%. Okay, let's see what's going to come out. Okay, what is the return on assets?
so net income, so the 450, oh wait, no. So 31,800. Okay.
Divided by assets.
249.
Total assets are
24977.
249,770. It's 12%.
Net income, which is just
Next one is return on equity.
so net income.
So equals return change of the income over equity. Total
Yeah.
equity.
That was the
Total
reverse.
equity is, where's that?
It's just reverse on the last thing we did.
Here.
Yep.
Total equity. Which is 20%.
So according to the equity that we have, like 20% is coming in return. According to the assets we have, like 30% is coming. And according to the sales, we are making like 7%.
Oh,
That's income, profit.
Oh. Well, our profit
then-
margin is 7%,
Yeah,
right?
and if we multiply all those,
Right?
so net income over sales, times sales over assets, times assets over equity.
So that's everything that we just did.
Yeah, but it is net income over equity. This is, I don't know what it is, but
Wait, what'd you
net
say?
income.
It's we got our,
What was the net income? 31?
no, it's 7%.
Hold on. 31, right? The net income over the equity,
Yeah.
which is
Yeah.
162. So the number is 20%. You know why? Go table to show you.
Wait, the ROE is 22?
This is multiplier of these things, right?
Yeah.
Okay. So that'll be it. Sales to sales, they cancel each other.
Oh.
If that's they simplify, right?
Yeah.
So it is actually net income over equity,
Times equity.
which is return on equity. So in order to find return on equity, it says you can multiply profit margin times what is sales over assets? Sales over assets, total assets turnover, right? Times assets over equity. Where is assets over equity?
Equity multiplier?
Okay. Which one?
Left,
Left over
up a
here.
little bit, or right there.
This
Right.
one.
I don't know, that's what I said. Is this what I said?
Total assets over total equity. Yes.
Okay.
Yes. So equity multiplier times total asset turnover times profit margin gives us return on equity.
Oh, wow.
So basically, it's net income times equity, period.
Net income's over equity, yeah, divided by equity. That's what we're looking for.
Okay.
And it makes sense. We're saying that how much equity, for each amount of equity, how much net income we will have. Okay. All right, so 7%, 9%, what was the numbers?
7%, 9%, 31. No, 20.
7, 13, 20.
13, 30. And then the last one is
The last one is net income over equity, is the same thing. This is why I didn't multiply them.
Oh,
You were saying that
yes,
multiplying, I saw that.
You didn't even think about just, canceling all the things out.
The only things that we didn't do over here, I will send this Excel to you guys. Okay? So I was writing here all the other ones. We wrote this current ratio, quick ratio, cash ratio, total debt, and all those. I think they are all here with abbreviations. Okay?
Can we say we're done? So you know that we're
So
done.
is this?
It's not one of those things.
No, it's not.
Oh.
Yeah, I know, right?
Yeah,
I ain't gonna miss that. You got
We're
it.
done.
You just have to get.
We didn't do this number 3, asset utilization of turnover ratios. Do you want to do this over here too?
No, we did do that one.
No, but I
Oh, you did?
Oh,
Oh,
yeah,
gotcha,
yeah,
gotcha,
okay.
gotcha.
So inventory turnover is actually just what it is. Inventory commercial sales. The cost of goods over inventory. So cost of goods was 350 by 8 kilowatts, 36 over inventory. Where's our inventory?
Sorry, what is the price per share?
We haven't discussed that.
So you, that,
Yeah.
What bridge is finished, just so you know, Professor.
All right. You got a question?
No, I said, what bridge is finished, just so you know.
So, what bridge do you want to have a question?
No, I said, what bridge? No, we are finished Just so you know.
Okay, all right.
Yeah, we'll complete it.
Okay, thanks.
Something called loan time, whether it's external assets.
Minutes.
Yeah. Because total assets are equal to total equity.
So, formula ROE is not formula, it's that income. The ROE equal profit margin by external assets.
Okay.
So what is the profit margin like 10%?
Okay, let's discuss this. Okay, we will talk about these two. So return on equity. This is something that the owners really like, and of course, this is the ultimate income of the business. If it can have a higher return on equity and it can sustain it, of course, the share price will go up, and if the other ratios are also healthy. So return on equity is one of the most important ratios over here. And how do we calculate it? We take the net income and divide this by the total equity. So that gives us the percentage profit for the shareholder. Now, the return on equity can also be written like this. Can you derive this formula? Okay, let's do it this way. Return on equity, which we call the ROE, equals to net income, or net income divided by return on equity.
Oh, is it?
Total city. Total.
Divided by equity. This one. The first one. Net income divided by equity. Which makes sense. That will give us a percentage of return. If this is, for example, as you said, 10%. In other words, the business is earning 10% return for the owners on their investment. So if the total investment, owner's investment in the business is $100 million, the business has a net income of $10 million. Make sense? Okay. But this ratio can be rewritten. So let's rearrange it. This net income and divided by equity, I can multiply this with sales and divide it by sales. It doesn't make any difference, right? Because these two can still cancel out, and we will get the same thing. So I can rearrange this, and this net income divided by sales, I can take this one over there, multiplied by sales by equity. Make sense? Okay. I can then do another thing. I can multiply this by assets and divide this by assets. Then again, cancel out, and the net result is the same as that one. Okay. The reason I'm trying to do this is to arrive at this equation. This one. Okay? So, we can rearrange this net income divided by sales, which this ratio is what we call the net profit margin, right? We can take that A over here, assets divided by equity, and if you remember, assets divided by equity is the equity multiplied. And then this sales divided by assets. This one assets. Sales divided by assets is the assets turnover ratio. So what we did is that we transformed this simple equation into a rather complex one. And this is what we call the DuPont identity. This was initially developed by the DuPont company in order to have a deeper analysis. Now let's try to understand the logic. So, we say that net income divided by sales. What if we increase this number from 15% to 30%? Sounds good, right? But how is that possible? If we increase, that will be possible if we increase the sales and we increase the net income as well. But if we increase the sales, then this ratio is also going to increase. Okay? Asset turnover ratio will also increase. Again, keeping the equity constant, these other ratios will also be disturbed. Make sense? Okay. Now, if we increase this sales, which is in the denominator, then that sales, which is in the numerator, also increases. So this increase and that increase cancel each other out. Okay. So what we need to do is to reduce our expenses in order to increase net income. And in order to reduce our expenses, we may be damaging the business in other ways. So what that means is that in order to increase the sales, you will also have to increase assets, because more sales is not possible without increasing assets. And if you increase that one, you also increase this one, so these two increases will cancel each other out as well. So the nutshell is that all these ratios, this is a separate ratio, that is a separate ratio, and that is a separate ratio. What that means is that all these ratios are interconnected. And having a better ratio in one case and just looking at that and you think that that is a very good one may be misleading, because this is affecting the others in a negative way. And the net result may be probably the same, is 10%. Does that make sense? Okay. Okay. Now the next one, the market value ratios. So the first one is the price earning ratio. Price earning ratio is what we call, this is the market ratio. We take the price of the company's share in the market. So that is readily available. If this is a public company, the share price can be obtained from Yahoo Finance or Google Finance or any other investor site or brokerage site. You can easily get the current market share price of the company. And then you can calculate the earnings per share of the company as well. How do you calculate that? You easily know the number of shares of the company. Number of shares. It can be searched, or it can be taken from Yahoo Finance or Google Finance or from the company's annual report. So whatever the number of shares are, 1,000. Okay? And the net income of the company, which is obtained from the income statement, if that is, for example, 2,000, it earned $2,000. What is the earnings per share? EPS. The earnings per share is 2. 2,000 divided by 1,000 equals to 2. In other words, the company earned $2 for each share of the share. Now, is a bigger number more favorable here? Of course. Investors would like to have a higher earning per share. And this is what we may also call it the earning power of the company. It has a more earning power for the shareholders.
So you said company earns
$2 for each share. For each share, because there are 1,000 shares, and the net income is 2,000. So you divide that net income by the number of shares, and you get.
The net income be divided into dividends and the earnings. So then this is $2 per share, so we're not dividing anything.
Okay. That This $2 per share does not mean that we're paying this out to the shareholders as dividend, but we earned it, and it's the shareholders' money. So we may retain half of that. $1 per share will be retained, and $1 per share may be paid out as dividend, or maybe all of that may be retained. But it is still the owner's money. We earned it for the owner. It belongs to the owners. It will be added back if we retain it. It will be added to the owner's equity in the retained earnings. So it is still the owner's money. It's only the earnings per share. And the next one is the market to book ratio. The market value per share divided by the book value. So, you know the market value per share. You know the market capitalization? Or the market value per share is the market share price, isn't it? Yeah. And that can be easily, should I find that out for you? Easy, right? You can go search the share price of any company, you'll get it. So the market share price is what we call the market value per share. Is equal to market price per share. That can be easily taken from Yahoo or Google Finance. That's a book value per share.
Sorry, flipping over.
Is you take the book value of the equity. In other words, the total equity and divided by the number of shares. So this total equity is taken from the balance sheet. Total number of shares. So this way you get the book value per share. The next thing to calculate is the market to book value. So this is the market value per share and this is the book value per share. So the market value per share divided by book value per share will give you the market to book value. And if this market to book value per share is equal to 3, for example, that means that the market is willing to pay 3 times more for the company's equity. And why would the market do that? Only if the company is really performing well. And that, if the existing owners right away sell all the shares of the company, they will get 2-3 times more than what they have in the business. And that can be added as the what we call as goodwill for the owners. But again, the goodwill is something else that depends on the total assets. But in this case, the market is willing to pay a higher price for this one. Now let's look at some of these ratios in combination. So earnings per share, and we have got 2 companies, A and B. For these, for company A, earnings per share is 5, and for this company, that is 3. Which one is good? A is good. Okay. And then you have got the market to book value per share. Suppose this company, that is 3 and this is 5. Which one is good? B is good in terms that the market is valuing this company more. Now there can be a number of things. If you see intrinsically, this company has more earning power, but the market is assigning it a smaller value. And this company has a smaller earning power, but the market is assigning it a higher value. And there could be a profit potential of it. The market may actually does not know the true value of this company. And this company may be undervalued. And you may want to look deeper into this company, do some further analysis, and if things are going good, if other signals are positive, you may want to buy the shares of this company. Because as soon as the market comes to know about the true value of the company, the share price will increase. And you can earn money on this. So this company may be undervalued. Or if this is not undervalued, this one may be overvalued. Make sense? So you can look into these things. The next one